The S&P 500 typically sees a 10% decline usually every 12 to 18 months. Sometimes it can be longer. I think we had one in the 2010s where it went like 3 years without a 10% market correction. It might have even been longer. I can't remember quite honestly. But you usually see a 10% dip in markets every 12 to 24 months. Like that's pretty standard in the S&P 500. But Mark, we don't have recessions every 12 to 24 months.
No, thank God.
How frequency of recessions is usually every like 7 to 10 years. Like
That's probably what we're up to now.
that's kind of like the norm. And so where my thoughts are on this is that the fear of a recession is typically what gets you that 8 to 10% drop in markets. And just think back over the last couple of years as an example. In the spring of 2023, when Silicon Valley Bank blew up and everyone was scrambling like, hey, what does this mean? What is this going to do? Like, is there something bigger that's coming? The S&P 500 during that time, again, spring of 2023, went from around 4,200, I think it got up to like 4,195, down to 3,800. 9% drop. Recession did not materialize, and the S&P 500 went on its merry way and continued on. Later on that year, in the fall, or heading into the fall, we once again had recession fears. Remember we were talking about the labor market at the end of 2023, like, hey, is there something that's building here that's making us nervous? Again, the S&P 500 fell from around 4,600 down to 4,100, and then bounced when recession didn't happen. Little more than 10%
does that mean the
fall.
to you, does that mean the stock market's a bad indicator?
No, to me it means that
A flawed indicator?
the first 10% drop that you have is built on investor sentiment and fear. In order to get more than that, the economic data has to worsen. Is kind of where I'm at, because let's think about what we're actually seeing here. Right before this all started, the S&P 500 was trading like 22 times forward earnings. Today it's trading at 20. Or the other way that you can look at it, maybe it's still trading at 22 times forward earnings, but we're just sucking 10% growth out as a possibility, like if there's a chance there's a recession. And so in my mind, that first 10% drop is just the fear response in markets. It's, hey, is there something out there that we need to be worried about? In order to progress beyond the 10% drop, the economic data has to conclusively worsen. Let's talk about the two most recent times that we've seen that data conclusively worsen. 2022, inflation went to 9%, and oil prices were through the roof. And remember, you couldn't, like, everything was backordered, delayed, this and that. The economy was bad. We didn't technically enter a recession in 2022, but we made the argument at the time it didn't matter. It was a bad economy, whether you formally declared a recession or not. The S&P 500 ended up falling a little bit north of 20% over the course of the year because the economic data got bad. It wasn't just the fear of bad, it was the reality of bad. The one before that, 2020, all happened in a span of like 3 weeks. 2022 played out over the course of 10 months, from January through October. 2020 played out in a course of March, where the S&P 500 lost 35% in 3 weeks, the fastest ever decline of that magnitude, because stuff was being shut down all around the world because of the outbreak of COVID-19. And so ultimately, you know, when we look at this and this question of slowdown or recession, it's still not clear. The answer is, you're right, it still isn't clear, because the economic data, by and large, is very similar to what it was over the last couple months. We just got the jobs report for February. No big meaningful change. There's some stuff under the hood that you look at and you're like, okay, like I'm concerned about this, but nothing big. Weekly jobless claims are still within sniffing distance of what they've been at in previous, years and the norms of what we see there. The places where we've seen a little bit of dodginess, retail sales, maybe a canary in the coal mine, slowing down in February, but it's unclear if that was just people had front-loaded good purchases because of tariffs. Are people actually nervous about we don't know. And other than that, a lot of the other data that we get on either a weekly or monthly basis is not really showing any meaningful statistical change. It's just kind of going along. So the point that I get to, I think, Mark, is, look, the next few months and how the economic data moves is going to determine the next move for markets here, because fear can only take you so far. Eventually, if you want to if you expect to see a bear market for, the index, you have to actually see the bad stuff start printing in the economic data and earnings reports. That's kind of where I am. And to this point, it just hasn't been printing. Not at a high enough frequency, at least. You get some scattered stuff here and there, but, NVIDIA's earnings, yes, the stock ended up getting punished, but the earnings were fine. Apple's earnings, the stock got punished, the earnings were fine. Actually, Apple was the one tech company that didn't really get punished. So I think that where I am on this is it's unclear if the U.S. is going to go into recession or not. If the data continues to worsen and the worsening expands to new areas in the next 3 to 4 months, sure, there's a real problem there. But we've also seen this story multiple times in the last 2 to 3 years where you get a couple bad months of data and then it doesn't go anywhere. And so as I've been saying since 2022, let's just slow our roll a little bit on the recession call and everything, because it's just been so overprescribed at this point as definitively happening. If it happens, you don't have to be the first to say that you called a recession. You can sometimes just wait to see how the data unfolds and go from there.